Hello and welcome to this week's special presentation. My name is Jim Penna, Manager of Retirement Services here at VectorVest, and I'm very happy to be hosting this week's topic, which is titled, How to Profit in Up and Down Markets. Now, both bearish and bullish market trends represent tremendous opportunities to make money, and the key to success is to use strategies and ideas that can generate profits under a variety of market conditions. This requires a consistent, disciplined trading system to be in place. My goal in this presentation is to illustrate for you investments and trades that can prosper in up or down markets. Let's start with upward or bullish trends in the market. Take a look at some of those strategies. So how to profit in an up market? Well, there's several ways, of course. The first being a long position or just being a long stock or an ETF. It's simply the purchase of a stock or ETF in anticipation that its price will rise. The overall objective is to buy the stock at a lower price, sell it for more than you paid, and that difference, of course, will represent your profit. Pretty straightforward. Next, we have long ETFs. So most ETFs follow a particular market or index, such as the Dow Jones or Standard & Poor's, the Russell 2000. And those ETFs seek to replicate the movement of the indexes that they track. For example, if the S&P 500 rises by, say, 10%, if you own the SPY, which is the ETF that tracks the S&P 500, based on that index rising 10%, the ETF will rise approximately the same amount. And then finally, another idea or strategy to profit in an up market is to buy call options, which I'm going to discuss in just a moment. Next, let's talk about downward trending market strategies or ideas. How can we profit in a downtrending market? Well, first, instead of buying a stock, you can go out and take part as a short seller, create short positions in your portfolio. That happens when you borrow shares from your broker and you sell them. Here you're anticipating that the stock will fall. And if it all goes as planned and the share price drops, you can buy back those shares at a lower price to cover the short position, give back the shares you borrowed, and you can make a profit on the difference. For example, if you're short ABC stock at $50 per share and the stock falls to 40, well, you can buy back the stock at 40, close out that short position, and you would profit $10 per share. It can be a risky endeavor. It takes a lot of margin or cash to do that, but it's one way to profit in a downtrending market. Next are ETFs, contra or inverse ETFs as they're known. Here is where you actually purchase or buy an ETF and they go out and do the shorting for you. Here it produces returns that are inverse of a particular index. For example, an ETF that performs inversely to, say, the NASDAQ 100 or the Qs, the triple Qs. That ETF will drop, let's say 10%, if the index rises by 10%. So it has an inverse relationship. But if the index falls, the ETF will rise proportionally. So this inverse relationship makes buying contra or inverse ETFs helpful for investors who want to either profit from a downturn or who are looking to hedge long positions in their portfolio. And then there's buying put options, again, which I'll talk about in just a bit. Our founder and mentor, Dr. Bartolito, has presented the 7 secrets to making money with VectorVest many times over the years. I've had the pleasure to see him do that many times. And to this day, I still learn something new every time I hear the presentation. The 5th secret of the 7 secrets to making money with VectorVest is to learn to trade options. And why should you learn to trade options? Well, there's many reasons. The versatility and flexibility of options is an amazing tool to have in your arsenal. But specifically, number 1 is that options provide leverage, the ability to create significant returns on your investment by using less cash. Options can reduce risk in your portfolio and be used as a hedge. And because you have less cash outlay, you're reducing your risk as well. As I'll illustrate, there's a much lower cost to control shares of a stock or an ETF. A couple of weeks ago, I did a session on generating income using covered calls, so they're a great way to generate income. Specifically, I want to focus on alternatives to buying or shorting stocks or buying either long or inverse ETFs. So again, this is the flexibility and versatility of options. So let's focus on upward trending market strategies using call options. A call option is a contract, and like any contract, it has strictly defined terms and conditions. And it's also a security that trades just like a stock. There's a bid and ask price. There's market makers who are tasked with providing a fair and orderly market. A call option, again, is a security that gives the buyer the right to buy a stock at a certain price, which is the strike price, on or before a certain date, which is the expiration date. These are those strictly defined terms and conditions of an options contract. Here I have a quick visual of a P&L or risk profile of a long call option. On the x-axis here, you'll see the stock price and the option value on the y-axis. And you can see that as the price of the stock rises, so too does the value of the call option. Right? You can also see that your risk is limited. This red line is the most you can lose in this trade. As opposed to owning the stock, this red line, if you just own the stock, theoretically can go to zero. So when you're long or you own a call option, your expectation is that the stock will rise. Your risk is limited to the premium that you paid, and of course your reward is unlimited, as the stock can go to infinity and beyond. Now, one of the keys to being successful trading options is to be able to align them with the market trend. And so I'm going to use an example from just a few months ago when our DEW timing system went from a down to up situation. That was on November the 3rd of 2020. Most traders of options fail because they just refuse to align their trades with the market trend. And so VectorVest is very powerful in allowing us to recognize those short, intermediate, and longer term trends. For now, I'm going to use the DEW timing system, and that was the signal that it was okay to go place a call option trade. Now the case study I'm going to use is ENPH, ENPH. On November 3rd, ENPH, I think, was the second ranked stock in the VectorVest database based on value, safety, and timing. It was also in the top 3 or 4 of several of the good quality searches that I use in the VectorVest program. And so ENPH is going to be my case study here. And what I've laid out for us is just what's called the options replay from the VectorVest Options Pro software. It's just a trade simulation so I can illustrate the power of using leverage and using call options to profit in an uptrending market. So on November 3rd, we went out on that DEW up situation, found a good quality stock, in this case ENPH. And we went out, and I'm going to be using just one contract, to the January expiration of 2021. And with the stock trading right around 105 on that day, we bought the 105 call option and we paid $14.90. That was the last trade, or right near the closing price on that day. Okay. So that's the setup, and you can see what happened. The stock on this options replay screen will show you that the stock continued to rise, and I've just signaled out a couple of spots here just to make the point of how important trade management is when you're trading options. So here you can see that just in less than a month, we have a profit of $2,783. Okay, that's a return on investment of 186% on your initial investment of $1,490 for just the one contract. That is the definition or the illustration of leverage. Now, as you can see, the stock continued to rise after a short consolidation here. If I fast forward up to what's this, in just less than 2 months, we have a profit on the same trade of $6,100. That's a 400% return on investment. As long as the stock continued to rise and we were profitable, our risk management techniques most likely would have had us out somewhere in this range. Okay. Had we held all the way to expiration, we would have had even a nicer profit, but quite often the trade management, risk management techniques would avoid that greed in trying to capture the last penny. So we had some nice returns, as you can see, simply following the market trend, finding a good quality stock. Now, I also added a case study for profiting in an upward trend, and I'm going to use an ETF. You can go buy the ETF, but understand you can trade options on the ETFs as well. So on the same date, I used an example of IWM. It's an ETF that I often will trade options on to hedge or to profit in up or down markets. And the same idea applies here. We bought a call option. The January expiration, the stock was trading right around 160, so we bought an at-the-money call, and this one cost right around $8 a share. That's right around the closing price of that day for our example here. And you can see again, if we track it out, again, less than a month, we have a profit of over $1,800. That's a 227% return on our initial investment of just $800. And again, you can follow here and you can see that the market and thereby the IWM, or which tracks the Russell 2000, continued to rise, and we see once again in less than 2 months we had a profit of over $3,200. That's a 400% return on our investment. Again, the power of aligning your option trade with the market trend, and when done correctly can result in some tremendous returns. Next, let's talk about downward trending market and strategies we can use there. And here we're going to focus on put options. So just like a call option, the put option is a contract that you enter into with strictly defined terms and conditions. The difference here is that a put option is a security that gives the buyer the right to sell a stock at a certain price, which is the strike price, on or before a certain date, which is the expiration date. So it's a bearish trade. If I'm buying the right to sell someone else my stock or put my stock to the seller of an option, then that is a bearish outlook. And so here is the risk profile of a long put option. And you'll see it's just the opposite of the call option. Again, on the x-axis down here is the stock price. As the price of the underlying stock or ETF falls, and we have the option value on the y-axis, it continues to rise. Okay, so our expectation when buying a put is that the stock will fall. Our risk, once again, is limited. Again, one of the advantages of using options, you have limited risk to the premium that you paid. And here the reward is theoretically limited. Right? The stock could go to zero, and you would cash in. The strike price minus the premium paid would be your profit. And so I'll use the most recent, most dramatic example of just a little over a year ago. We know that on late February, on February 24th to be exact, the DEW timing system went to a down situation. And this is when the pandemic sell-off began. Just another verification of how powerful the VectorVest timing tools are. At that point, we weren't really sure what the pandemic was going to bring us, but the VectorVest program recognized that this trend was starting to move down. The confirm call came down a few days later. But for our example, we'll use the DEW down on February the 24th as we align our trades with the current market condition. So I'm going to use IWM again as our case study because it also worked out very well. So if you wanted to hedge or profit in a downtrending market on that date, on the 24th, again using the ETF IWM that tracks the Russell 2000, you could have gone out and bought an April expiration. So we're out about 60 days or so, and you could have bought the 155 strike, which would have been an at-the-money strike price on that day, and paid around $5.75. Again, I don't have exact intraday prices, but that was right around the closing price. Okay. And what I've done is marked a couple of spots here on the graph. And as you'll see, again, in less than a month, in this case, we have a profit of $2,500 or a return on investment of $436. Remember, we only paid $575 for the one contract. That's just doing one contract. You'll see that profit here down in the subgraph. Again, risk management techniques may have you out before the peak, but if you held it, that's still less than a month. We would have had a profit of $3,361. That's a return on investment of over 584%. Again, the definition of leverage, by simply aligning the proper trade with the current market condition. Now those are pretty straightforward examples. I put a case study in on the Qs, which tracks the NASDAQ 100 here. And I said earlier, you have to have a very specific plan. You have to be committed and watch the market, read the VectorVest views each day. So I put in an example here. As we know, just recently, we had the Qs, or the NASDAQ has taken a big hit recently. A lot of that, as we saw in the headlines every day, is that interest rates, the 10-year notes were rising, and so that was hurting NASDAQ and tech stocks in particular. So a great way to profit from that downtrend would have been to go out in a downtrending market for this industry or this sector, would be to buy put options on the Qs. And so we did. We bought one put option it was right around the 19th of February of this year. Now this one's a little different because we didn't wait for the confirm down or the DEW down. There were red lights in the price column. The primary trend had gone down right in this time frame. So it would have been a good indication that the market was beginning to find that top and begin to turn over. So I just wanted to illustrate the power of this for even the shorter term. If you're looking at the headlines and you're following the VectorVest views, you would have seen that it would have been a good time to go out and play the NASDAQ to the short side. Buying the April put option in this case, right? Buying the April put option, the 331 strike, which would have been an at-the-money strike, costing around $13 per share, would have netted us very quickly a 95% return on that investment. And then if you held, it would have been even higher. But once again, this would still be an open trade. You'd still be profitable even as of today. But keeping an eye on the market, following the color guard, seeing those red lights, and understanding that tech and the NASDAQ were under some pressure would have been a great time to prosper in a downtrending market for the tech sector. So again, both bearish and bullish trends represent tremendous opportunities to make money. And I said earlier that the key to success is to use strategies that can generate profits under a variety of market conditions. I also said earlier that it requires a consistent, disciplined plan to be able to do that. Okay? So my goal was to illustrate for you the power of understanding when and how to place these trades so that you can prosper in a bullish or bearish market. Now, if you'd like to learn more about using option trades to prosper in both an up or down market, stay with me for just a few more minutes and I'll introduce you to the Options Jumpstarter course. The Jumpstarter course is 6 weeks to profitable options trading. It's a complete step-by-step system that shows you how to buy calls and puts, again, to profit in both up and down markets. We'll take you by the hand. We'll guide you through the exact step-by-step option profit system that you need so that you can leverage your money with options. Now, the outcome of the course is that in the next 6 weeks, you'll be able to confidently find, set up, and manage the right option trade at the right time to make money whether the market's going up or down. Now, if you're new to options or have struggled with them in the past, this is the course for you. We put this course together for people who want a system to trade options the right way. I'm going to tell you all about the course. Before I do, just understand, they say there's no such thing as a risk-free trade. Well, this is actually, because after the course is over, if you show you've done the work and you're still not satisfied, we'll gladly give you your money back. You can go to vectorvest.com/jumpstart to sign up for the course. And the easiest way for me to explain the course is to map it out for you, lesson by lesson. So we'll start with Module 1. It's called the Option Foundation Builder. It's so important because a lot of people try to learn options and get frustrated by all the terms, and they focus on the wrong things as they start out their journey to learn option trading. It's a clear and easy to understand framework so that you'll know how calls and puts work, and you'll know which terms to pay attention to and which to ignore so that you don't waste time or get frustrated. Module 2 is all about the trade you need to generate profits in up markets. I talked about call options in the presentation. It's so important because you want to take advantage of those explosive up moves because they can really make your year, as I showed in just a couple of basic examples. The outcome of this module is you'll learn the exact signals to look for, to identify those market blast-offs so you know when is the best time to trade calls. Okay, you'll also have the exact rules and system for successful trade setups. Module 3 does the exact same thing, only on put options, so that you can profit from a downtrending market as well. Module 4 is all about trade selection. This is important because you don't want to just place option trades on just any stock. You want to have that stock aligned with the market and find not only the best stock, but the best option candidate. So the outcome in this module is how you'll quickly find the best stocks for your trades, both bullish and bearish, how to match your trades to the market, and how to identify which stocks make the best option candidates. Probably most important, and where most new option traders fail, is trade management. Here's where you prepare yourself for what could happen after you place the trade. So the outcome here is you'll have a game plan in place prior to placing the trades, so you know when you'll exit, whether the trade goes for you or against you. And then what really separates this course from many others is that we'll help you execute your trades. We'll show you how to go into your broker, how to enter your trades correctly. Okay. The outcome from this module is you'll know exactly how to place orders to both enter and exit your trades. And we have checklists set up so you can place your trades confidently. So by the time we're done, you'll have a straight line system that we talked about to use options to profit in both up and down markets. Now, there's some bonuses that come along with the course. We have a bonus session called Covered Calls for Income. It's the most popular, the easiest income option trade there is, and we'll do a bonus session on it, consistent income every week. We'll show you how to get paid to own your stocks and where you can profit even if the market moves sideways or falls slightly. My favorite part of the course is for those who choose the Mastery package, you get 6 live Mastery support sessions. Okay, think of these as implementation sessions. So once you've watched the module or the lesson, we'll go over in the Mastery session any questions that you have, and we'll help you to implement what you learned in each module. And if you can't make the live session, don't worry, you can submit questions through a dedicated email bin and then watch the recording in the VectorVest University. Just real quick, here are the actual dates for those. They start on March 24th. They'll be 11 a.m. Eastern Time. And then the bonus module will come the following week after the course is over. So the special price ends Monday, March 15th at 5 p.m. Registration for the course itself will close on Tuesday at 5 p.m. So take advantage of the $495. This is our best value. So for one full year after we're done with the course, you have access to the material in VectorVest University. You'll get the bonus session, and then you'll get 60 days of the VectorVest software if you're not a current subscriber. And then finally, the bonus modules taught live along with the live mastery sessions. Then we also have a self-study package at $295, but you miss out on the modules and the live mastery sessions. So VectorVest.com/jumpstart will get you there. Remember, it is a risk-free trade. We'll give your money back if you're not satisfied. How much is it costing you not to do this? That's the question you have to ask yourself. How much money will you lose by trading options incorrectly? How much potential profit will you miss out on because you don't know how to use options the right way? How much time and energy will you spend trying to do this on your own? And then ask yourself how life might be different if I do this and it works. So again, go to VectorVest.com/jumpstart, choose the mastery package. It'll walk you through the registration process. And I hope you take advantage of that. I look forward to seeing you on the March 24th mastery session. If not, maybe next time. Thank you so much for taking the time to join me for this presentation, and I look forward to seeing you next time. Stay safe, stay healthy, and we'll see you next time.